There is a common saying which goes as there is a common saying which goes as there are bored and young investors, but there are no old and bored investors. Now, there must be a reason why we don't have old and bored investors. That's exactly why I am going to give you a reason why your investing journey should not cease to exist a few years from now. There is another alternative to stocks, which if you use it together, blending it with stocks, you are going to survive over a long period of time. As we have been saying in previous videos, the stock market is so unpredictable, and the only way which you can be successful in the stock market is by investing for the long term. Now, there are some instances where stocks would be disappointing. We need to have a backup plan, and that is bonds. What is a bond, you may ask? I am going to use a good example, and this example is going to relate to stocks. In when investing in stocks, we say you are buying a part of a business. Let's now say you don't want to buy that business. You don't want to invest in that business. What should be the alternative? The alternative is you lending money to this business. But there is no free lunch. This money which you are going to lend to this institution or to this company is supposed to be returned back to you, and there is supposed to be some interest which you are going to gain from this money which you will lend this institution or this company. And that is how generally bonds operate. Bonds is a loan which you lend to a given institution or a government. Government do offer bonds. At the same time, corporate institutions can also be operating through bonds. A bond is whereby you lend money to an institution, and this institution promises you an interest, which normally happens twice a year. For example, if you have given out 100,000 Kenyan shillings at an interest rate of 10%, it means this institution is supposed to give you 10,000 in total in each year, which you are going to lend this institution. Now, this interest, they are going to subdivide it into two. They will give you 5,000 after every 6 months. So by the end of the year, you would have earned 10,000 as an interest. Now, who are responsible to give out bonds? Who are these individuals who can come to the market and ask for loans which are in the form of bond? The government can give out loan, can ask out money from its citizens, and this normally happens through either treasury bills. We have also bonds which mature between 10 between 2 to 10 years. Treasury bills goes for one year, the maximum. And also we have other long-term bonds which last between 10 years to 30 years. Now, what are some of the things which influence the interest which you are going to gain from bonds? Things which affect the interest which you are going to gain from bonds: one is the time which you are going to lend your money to this institution, either the government or a corporate business. If you are going to lend this institution for the long term, which means there would be a higher risk, then you are going to gain a higher interest. But if you are going to lend for a short period of time, like in the treasury bills, you are going to gain a low interest. Another thing which is also associated or which can affect the amount of the interest which you are going to gain is now the risk itself. There are institutions which you are assured that you will get your money back. It's not 100% sure that you are going to get your money back, but there are high chances from this institution that you are going to get your money back. This institution tend to give low interest rates when they are going to borrow this money. But those institutions which are you are not sure, which they don't have a quality history of giving out money, then their interest rates are higher. That's actually how bonds operate. Now, what are some of the advantages of you investing in bonds? Number one, you are assured if you are going to invest in high quality bonds, you are assured you are going to receive your interest and also your principal back. At the same time, it is a steady flow of income. Once you have given out your money, you are assured every after 6 months you are going to receive your interest. It's not like when it is in stocks. The company may decide either to give you dividends or not to give you dividends. But when it comes to investing in bonds, you are assured you are going to receive your interest at every after 6 months, and also your initial principal when the bond has matured. Another advantage of investing in bonds is you are assured most of the time, if the interests are higher, that you are going to beat inflation. So most individuals who store their money in the bank, they lose their value through inflation. But once you have invested in bonds, you are assured you are going to beat inflation. Now, what are some of the disadvantages which are associated with bonds? As we have said, there are institutions who may decide to default your loan or your bonds, which are both, and you may end up losing the initial principal. At the same time, you may end up losing the opportunity of you earning through interest. If you end up investing in low quality bonds, it means then you are going to face this kind of a risk. Another issue which is associated with bonds, as we have discussed, bonds are normally affected by the interest rates which are currently in place. If there are higher interest rates, then it means your bond is going to lose value. But if the interests are low, it means your bonds are going to be of quality, of good quality. Their interest would be higher. So this is also a disadvantage which is associated with the bonds. Another disadvantage which is associated with the bonds is the institution, either the government or the business which has you have given the money, may decide to call off the bond. That is, they may decide to pay you earlier as opposed to the time which was agreed. Now, if they end up paying you earlier, it means you are going to lose that opportunity of you gaining some interest from this institution. Those are some of the disadvantages which are associated with the bonds. Now, should you go ahead and invest in bonds? As we have said, when we are going to do our investments, we need to diversify. And as we have discussed it before in other videos, the stock market will ensure us we beat inflation. But there are times when these stocks don't perform so well, which gives another alternative which we have, that is investing in bonds. Now, if we are going to invest in stocks and bonds, we are well well positioned either not to be dismantled completely when, for example, the stock market goes berserk, but we are able to sustain those challenging moments in the stock market if things are not working okay. And if things are also not working okay in the bond market, we will be fine because the stock market, there are high chances it will be performing well. So that is the clear definition of what bonds are, some of its advantages and disadvantages. So if you have more questions, leave them in the comment section. Would you start investing in bonds? Thanks for watching. See you in my next one. Friday, I will be uploading every week.